welcome today. We have the pleasure to welcome Adam Blitz, who is the CIO of Evanston Capital Management, what we often refer to as ECM. ECM has been a long-term partner of Sendero and an important avenue for us to access alternative investments for our clients. Adam, welcome. Can you just give us a little bit of a brief description of what Evanston Capital Management does and a bit of its history as well, too?
Sure. Yeah, great to be here, John. Thanks. Yeah, so Evanston Capital has been around 22 years. We manage a little bit over $4 billion, and mostly in alternative investments and investments in hedge fund managers. We also do some investments in venture capital and blockchain types of firms as well.
Very good. What's the origin of Evanston Capital? Obviously, we know you picked the name because that's the city in Illinois that you reside in. But can you give us just a bit of history as to of the origin of the firm?
Yeah, absolutely. So yeah, we were founded 22 years ago, and really our lineage is back to the endowment foundation universe. Our primary founder was Dave Wagner, who had been the chief investment officer at Northwestern for 10 years. And then prior to that was the chief investment officer at a foundation in Pittsburgh. So really bringing that endowment foundation lineage. When Dave was at Northwestern, he built a significant portfolio of alternative investments, including a large amount of investments in hedge fund managers. And really the philosophy that he had when he was at Northwestern still carries forth today in terms of there's not that many great alternative investment managers or hedge funds. It's our job to identify them, gain access to them, and know when to move on from them. And so really that thought process of building portfolios at Evanston Capital in a manner and quality like someone would build a portfolio within a top endowment.
Great. Yeah, that of course, and that's really the reason, the rationale as to why we looked at Evanston and got involved. The what we sort of traditionally think of as a fund of funds approach to hedge funds, and in fairness, that's a little bit of my heritage as well too. In that business. Adam and I were once competitors in one sense of the manner, rather than being partners for our clients now. Given the all the caveats that we have to put around the idea of past performance, we don't want to specifically talk about performance or performance numbers. But I think if we look back at your 22-year history at ECM, uh, your performance tells us relative to equity markets in particular a lot about what the importance of including an exposure to something like ECM is for diversifying portfolios and what type of returns ECM and when they tend to deliver returns versus even the equity markets are. Could you elaborate on that a little bit?
Yeah, sure. Really what we're trying to do and what hedge fund portfolios are trying to do in general is deliver a source of return that's different from the sources of returns that investors are getting in the rest of their portfolio. So we're not trying to deliver a return that's exactly like the equity market or exactly like the bond market or heavily correlated with economic growth. We're really trying to deliver a return that's distinct from all of those forces, such that it can really provide diversification in someone's portfolio. But we also want to provide a return that's meaningful enough that it can move the dial of someone's performance, right? If we were just providing diversification but didn't provide performance that's any better than cash, we're really not providing any value. An investor could just put some money in a CD at the local bank and achieve diversification and risk control that way. So we need to deliver, what we call alpha, positive alpha, which is really performance, excess performance that's really defined by a manager's skill. And if we can deliver that sort of excess performance and deliver a return that's not heavily correlated with returns of traditional stock and bond markets, we feel we can play a very valuable role in portfolios.
You hit on something that I think is an important point there, and that's sort of this whole idea of skill and of alpha. And I want to return to that in a few minutes. But when you approach looking at hedge fund managers and looking at hedge fund investments and building a portfolio, I know Evanston excludes a certain investment philosophy that you use to that, and there are, I believe, five core beliefs that you've articulated. I think it would be useful for our audience to understand where it is that you're coming from and what some of those core beliefs are.
Sure. So there's really both hard and soft factors that we're looking for. Certainly, one thing we're looking for is demonstrated skill and edge from an investment perspective, and typically what that involves for us, we think, is having expertise in a fairly narrow area, knowing that area extremely well, but not managing so much in assets that you can't take advantage of maybe smaller opportunities within that particular area. So just to give some examples, probably the largest strategy within hedge funds would be long short equity strategies. These are stock pickers. They go long or buy the things they like. They go short the things they don't like that they think might be overvalued. We've generally had a strong preference for sector-focused managers. So it's just, seemed to us that if you're an expert in a particular sector, such as technology or real estate or financials or energy or whatever it might be, you're just going to be in a better position to understand the dynamics of those industries, who the future winners and losers would be, than if you're some big generalist manager who can, go to every sector and managing tens of billions of dollars. So really having that level of expertise, we think is important. That would extend to other hedge fund strategies as well. Some strategies are in the credit area, and we think having historical expertise in restructuring companies and bankruptcies is important. But really, in any strategy, just really looking for that area of expertise. But that's not enough in and of itself. I think a lot of soft factors also weigh into our evaluation. We found over time that the very best managers who can sustain excellent performance are not only very skilled in a quantitative sense or very skilled in the sector that they might traffic in, but they're also very passionate about investing. They love what they're doing. They're competitive. They're ethical. They run good businesses. They have good business partners around them. Set up their business in a thoughtful way. And if you can marry that investment skill with a real passion and competitiveness and drive and love of investing, marry that with a good business, that's sort of the recipe for sustained success. And there's really not a lot of managers in our view who kind of hit on all of those factors. So we might meet with 200 or 300 managers in a given year, but only make 3 to 5 investments. So it's a very high bar and hurdle for all of those attributes to hit.
Yeah, no, that's very interesting. And one of the points that you recently distributed to investors an outlook letter, and I think I don't want to characterize it that it was a rosy outlook necessarily, but I think it was much more upbeat than it has been for a number of years in terms of what the opportunity set looks like for hedge funds. Can you just discuss a little bit of some of those contributors, those factors that are sort of contributing to the improved opportunities that you believe exists for the hedge fund arena?
Yeah, absolutely. Yeah, we're extremely enthusiastic about the opportunity set. As John notes, we're always talking about our outlook in all of our quarterly letters, and we're not perpetually and always as this optimistic. So I think the reasons for the current enthusiasm, it really extends across all of the strategy areas, and maybe I'll walk through each of the 4
Mhm.
strategy areas and why we're optimistic.
Right.
So long short equity, that like I mentioned before, the stock picking types of strategies. We just think you have a very interesting sort of combination right now where the competition within the strategy area from other managers is as low as it's been in some time. but the opportunity set, because of all the rapid change across so many industries, is as high as it's been in some time. The reason the competition is low is really since the global financial crisis, you've had a significant move into passive investing, and then a lot of the active investing, certainly in the hedge fund arena, has gravitated towards a small number of very large sort of multi-manager or pod shop type of firms who trade on very short-term, sort of quarterly type of earnings. And so it sort of left this white space for fundamental stock pickers who have a medium and long-term time frame to really evaluate stocks and I guess live through the inevitable sort of noise and volatility along the way to their thesis playing out. And so less competition on the one hand, then on the other hand, just rapid change. AI is something that everyone knows about, but that not only influences the technology and software sector, it can influence real businesses who might be able to run more efficiently. Some businesses might become obsolete due to AI. You have a theme of sort of increased power demand due to AI. There's just a lot of themes and change going on. A new administration that is certainly thinking of enacting policies, right, that we haven't necessarily seen before that might affect company A very differently than company B, even though they're within the same sector. And so we think there's just a huge opportunity set and very low competition right now. Now, that doesn't mean that every month the manager just does great, but it does mean that over time, if they can pick those stocks well, we think the opportunity set is unusually large. The next strategy I'd hit on would be event-driven strategies, and these are strategies where an event can unlock a mispricing in a company, and you've just had a dearth of events really over the last several years. Just very low merger activity, very low IPO activity in markets, and our strong view is that that's going to change for the better in 2025. You have more certainty around the level of interest rates. You're past a presidential election. There's a lot of pent-up activity that we think is about to be unlocked. And within our event-driven manager universe, we think the managers can sort of anticipate events that might make sense, capitalize on those events. And then on more defensive types of events like bankruptcies, restructurings, credit types of events, we also think that that's likely to pick up here over the next several years as a lot of companies need to refinance their debt at higher levels. Then the last strategy I think I'd touch on really is macro, where I think the opportunity set right now is just, it's really outstanding. I would contrast it to last decade where effectively volatility was very low. Every country had interest rates near zero. Not a lot of difference between one country and another. Now you have massive differences between one country and another. Some countries are fighting inflation, others less so. Some have inverted yield curves, some have positively sloping yield curves. We're talking about tariffs, one day and getting rid of them the next and putting them back on the day after that. All of that leads to a lot of volatility, uncertainty, and if you have a manager who can kind of evaluate all that, kind of pierce through all that noise to say, all right, what's real, what's not real? How does that affect this currency? How does that affect this commodity or this country versus another country? We just think it's a very robust opportunity set. So really across the board, we think it's a really excellent opportunity set, and hopefully the managers can continue to take advantage of that.
Yeah. Yeah, I think, you've hit on some interesting themes, ones that, we at Sendero also try to express in our, even in our allocations within the long only world, and that is to try to emphasize not simply just passive investing, which was great when money was free. We've sort of moved out of that world of free money now, and probably back to a more normal period from that standpoint. And I certainly know history doesn't necessarily repeat itself, but it does tend to rhyme from that standpoint. Are there any sort of historical periods that you can look back on and sort of think, we're coming into a similar type of environment for either active management or stock picking versus simply just being long the market?
Yeah, absolutely. Active versus passive historically has been very cyclical, right? So the decade of the 2000s was a great period for active management and not such a great period for passive investing. The 2010s was sort of the opposite. The best thing one could do would just be, long the S&P 500, and anything else you did around that would probably be destroying of returns. And then this decade's been more normal, I would say, so far in that regard. But I think we have a setup that's probably closer to that of when you're heading into the 2000s. Equity markets are, especially in the U.S., quite expensive on any metric. Doesn't mean that they're not going to do well, but historically, when equities have been at this level of valuation, and the perspective, returns, if you look out for the next 10 years, they tend to be, meaningfully lower than average. And it's a period, where you've had all this money flow into, just index and passive type of investments, and it's developed this sort of odd skew in markets where so much money has flowed into the very, very largest of our companies, and kind of the middle tier of names is just sort of forgotten about and left behind. And it's not obvious that if you were to look out 10 years, that those top 5 or 7 companies are going to be the same ones, down the line. And so I think there's just significant opportunities for value add from stock picking. I also just think, diversification is truly the only free lunch in finance over time. And it's maybe a lesson that's people have forgotten about recently, just due to the outperformance and exceptional performance of U.S. markets. And I think just sort of assuming that that's going to continue and be the singular place where you want to put your money, I just don't know at this level of valuation if that's the best move. A lot of markets are expensive, and I think just having a diversified portfolio, I guess, as Wayne Gretzky would say, skate where the puck is sort of going, and trying to take advantage of what seems like a very fertile, active environment, we think is the best recipe right now.
Yeah. That's great. One of the things I think that Evanston has always prided itself on is being both early with managers, and there's some managers I think you've probably been invested with for 22 years.
That's right.
That being said, you're often out there, and as you noted, you're always scouring the world for new managers and new strategies. What are some of the new types of areas that you've looked to diversify into?
Yeah, certainly. So I think, one area, fairly recently that we've gotten to would be catastrophe reinsurance types of strategies. I think we've all been reminded of this with the recent wildfires in California, but we have a major insurance supply issue in this country, right? And I think certainly insurance companies don't necessarily want to be holding risk against major catastrophes such as hurricanes and wildfires. And so there's a new market that's come in over the last several decades called the catastrophe reinsurance market, where money managers, hedge funds, can supply capital at what feels like a very high risk-adjusted rate of return to sort of take some of that risk away from the insurance companies. And it's sort of a win-win. It's a win for the insurance companies because they can offload risks that they don't want. Again, it's very hard to predict, large loss events. And it's a win for investors who can come in and get prudent amount of exposure to with a very high risk adjusted return that's uncorrelated to other investments in folks' portfolios. So this is something that we've tiptoed back into in recent years. It's something that we would evaluate every year based on the pricing environment in that particular year, but that's certainly a new strategy that we've gotten into.
Yeah. You mentioned earlier that you made the passing comment on pod shops, and pod shops are really what we think of historically as the multi-strategy hedge fund. And These are the ones I think people often hear about. They tend to be quite large and so forth. Um, and certainly a space that we at Sendero have often participated in. We tend to find them pretty tax inefficient, and so we tend to skew that more just to institutional clients for that reason. That being said, can you just elaborate a little bit on where you see some of the risks developing in those and how they're having to transform themselves to a degree? Because I think they're a very important market participant today.
Yeah, absolutely. And these pod shops, they're very large. Collectively, they control a lot of capital, so they're very, very significant player in the market. And really underpinning most of those managers is they're bringing in people to manage money internally in a very tightly risk-controlled way, hoping that they have some sort of skill set, combining them and then using a high level of leverage to generate returns that ultimately are attractive to investors. And so I think certainly some pod shops are more thoughtful than others about the leverage that they utilize, around the margin terms that they have with their prime brokers and the investment banks, in the event that they hit a rough patch in the terms that they have with their investors. Certainly, the last thing you want to do if you run a strategy that has a high level of leverage is to have a margin call or investor redemptions that could cause you to quickly liquidate, your portfolio, which with any sort of leverage can really cause a very serious sort of hit to capital. So I think the best firms are very more thoughtful about that. I think some of the ones who've sort of started their firms more recently, really to meet what seems like a high level of investor demand for these strategies, I think are less thoughtful about some of those risk controls. So that would certainly be a concern. And then there's only a limited amount of talent. There's not just a limitless supply of individual portfolio managers who can add value relative to the market. And so if you think there's a limited supply of that talent, but you have an ever increasing pool of capital across these sorts of managers, probably over time, you're going to find the best of that talent is going to gravitate towards the top, two or three of the pod shops. There'd be no reason for them to go with the lesser types of firms. And so, sort of that could cause the lesser types of firms to employ more leverage or take more risk just to try to keep up. And because there's a similar thread across all of these managers in terms of what they're trying to accomplish, we think that there's a risk that would be very hard to quantify. It might not come out in traditional risk models, but just given how much capital is managed in firms that have very similar approaches with very high levels of leverage, we think that's almost a risk in and of itself. Like the 10th best pod shop could have some sort of risk event start liquidating their portfolio, but because of the similarity across all of these managers, it might cause a significant event even at the very best of these managers. So I think there's definitely some some risk there. There's also a lot of positives to these sorts of approaches, but I do think at the end of the day, you're investing in strategies that have a high level of leverage and a lot of similarity in approach with other managers. And we've seen that movie before in convertible arbitrage in 2008, in quantitative equity market neutral strategies in 2007, where just an entire strategy has a risk event that would be impossible by any quantitative sort of standard.
How do you think about, given that that exists and you're really investing in sort of I don't want to say the same universe of strategies because they're not exactly the same, but these managers are still involved and have exposure in the same underlying set of instruments that Evanston does as well too. How do you mitigate those risks?
Yeah, it's a great question. I mean, I think one thing we do is avoid strategies that have very high levels of leverage. And so maybe another way to say that is we have a fair bit of tolerance for what we call mark to market volatility. So if a manager of ours is investing in a stock that's going to go from they think is going to go from 20 to 60, um, we know there might be pit stops along the way where they have drawdowns along that ride from 20 to 60 that could be significant drawdowns along the way and could be exacerbated by some of the short-term trading, by these pod shops and other shorter-term managers. Now, if the managers we invested have high levels of leverage, they wouldn't have that ability to sort of withstand those sort of inevitable drawdown types of periods. And then also, if they don't have I would say the wherewithal as a portfolio manager to be able to say, you know what, I still really believe in this stock, but it's just going through a bad period. There's a lot of noise. It's a rough month, but I'm going to stick with it. Or conversely, boy, this stock has fallen and actually something has changed in my thesis and let me get out of it. Like that's part of our evaluation is how we think they're going to evaluate and react, to all of those periods. Then they also need an investor base who understands, what their strategy is and what they're trying to do. And so if they're a excellent long-term stock picker and they have some rough months along the way for no other reason than noise in the market, if 3/4 of their investors are calling them up and screaming at them, hey, what happened this month? That might start to change the manager's behavior and thought process. And so we wouldn't want that, right? So we want to know the types of investors that we're alongside, just so there's a like-mindedness in what the manager's trying to accomplish, what their sort of volatility profile is, understanding that there's inevitable down periods along the way, but trying to differentiate between what of that down period is just noise and what might be mistakes that they've made. And so all of that factors into our initial and ongoing evaluation of these managers. But I still want to circle back to leverage because time and time again, the biggest risk events in hedge funds across any investing come from high levels of leverage. I mean that's the thing that almost always causes the most pain, and just simply avoiding highly leveraged strategies I think can save you from some of the worst of these risk events.
Yeah, I think that's very important because I think, what we know leverage does is it makes you crystallize a loss rather than just being able to ride out a rough mark to market.
Exactly.
From that standpoint. It's very important. Um, in closing, you mentioned earlier that beyond hedge funds, you've dabbled or entered a few different areas. You do a little bit in venture capital, and you've done some work early on in blockchain. And I don't mean by crypto. I really mean investing in the blockchain uh, uh, ecosystem. Can you just tell us a little bit about your experience in those areas?
Yeah, certainly. So yeah, I'll start with blockchain. This was really opportunistic to start a strategy in the blockchain venture area. We just had and continue to have a view that blockchain is a transformational technology that will help companies and individuals and just everyone basically sort data and find ways to just sort information in a more thoughtful manager, and ultimately could be the engine to a new web and other aspects like that. So it's as John said, it's not a bet that we're making that Bitcoin's going to go up over the next couple of years. It's really a bet that blockchain is going to be an increasingly important technology, and to get involved at the ground floor with some of the infrastructure that might power that, we felt had a very favorable sort of risk return. And so trying to identify small venture managers that hopefully can take advantage of that. So that was very opportunistic and really was born out of a strategy that we manage that does some venture investing, predominantly in more early stage sorts of software oriented companies, again, that we think have a very positive skew if you can kind of hit on that software. And it's just an interesting period in venture generally because some of the venture investments that investors made 5-10 years ago are really starting to get long in the tooth. Managers have been very slow to distribute capital from those investments. So there's actually a bit of an undersupply of capital for current vintages within venture capital, but the opportunity set is probably as good as it normally is, right? And so, as is often the case in venture type of investing, the best opportunities might come at the time where folks have the least amount of capital to put to work. So, selectively trying to evaluate the current opportunity set and take advantage of it is certainly something that we're looking at as well.
Good, thank you. This was great. I always enjoy having the opportunity to sit down and talk with you and talk with your team. I will note for our clients, Adam and his colleague Lance Donnenberg will be in San Antonio on March 3rd and 4th of this year. And we welcome the opportunity for people to meet in person as well, too. So, Adam, thank you very much for participating in this, and we certainly appreciate all your great insights.
Thanks for the partnership, and yeah, looking forward to being in San Antonio soon. Thank you. Thanks, Jeff.
Thank you.